What's going on, guys? It's Jordan with the Brantford Exchange, and today I just want to go over some quick tips on risk management to help grow your portfolio. These are some practices that Cole and I follow, and to this day they've proven to work, so hopefully you guys can use them and grow your accounts. So the first thing I want to cover is how to use support and resistance lines to know when to get in and when to get out of a stock. So this is Kronos Group. This is a marijuana company based in Canada, but that doesn't really play a significant role. This is just for an example. So if we look at some of my support and resistance lines, we can look here, for example. You want to get in as close as you can to the support line, because if you get in close to a resistance line, it has a good chance of getting rejected and then continuing to trend back down. If you get in at a support level, it has a better chance of bouncing off that and continuing to trend up. So this would be a support right here, trend up to this resistance level, where then you could either sell or continue to hold if it continues to break through that. When analyzing with support and resistance levels, you want to have a ratio in mind. So what I mean by that is that you want to have either a 5% potential for gain and a 1% potential for loss, or a 6% potential for gain or a 2% potential for loss, whatever it may be. So here's a little example with that. So if I were to get in right here at this 753, we'll call it 755. For my risk management, I would, if I was willing to risk 2% loss on this particular trade, I would put a stop loss in somewhere right around here. That way, if it broke this support, trended down and broke, my stop loss would trigger and it would sell the stock. So that would be willing to risk 2%. That being said, it could bounce off this support level where I would buy in as close as I can to the support level, have my 2% stop loss in. It could bounce off this, continue to trend up, and then get near this resistance level. So when it gets near that resistance level, that's when I personally choose, okay, do I want to hold it or do I want to sell it? Because it has a good chance of getting rejected by the resistance level and starting to trend back down. So I could either take my profit or continue to hold it and it could break through it and continue trending up. So that would be if I had a 6%, 6 to 2 ratio, we'll call it. So if I was willing to risk 2% for every 6% potential for gain, that would be this. So if I use my drawing tool here, this margin right here offers 10%. So that's good. I could put in my stop loss, and then there's 10% margin from this support to the next resistance. So I could hold it, and if it gives me that 6%, great. I could take it and run with it, or you could just hold it and then see what happens from there. Another thing I wanted to go over for risk management, so that is the ratio part of it. The other thing I wanted to go over was whatever stock you're trading, you really want to know how it moves with the market. So what I mean by that is some stocks don't move if the market, say the market's going down. Like right now, we're experiencing a downtrending market. Some stocks don't really get affected by that. So utilities are a good example. Pharmaceuticals are pretty steady. The reason being is utilities, like I just said, everybody's still going to pay their electricity bill. Everybody's going to pay their water bill just because the market's not doing too hot. Those are essential things that people need to, live. If it's cold in the winter, you're going to pay your electric bill and heating bill to stay warm. So they're essential things. So they usually tend to stay pretty steady. So this is Amazon, for example. So we have Amazon. Amazon's this dark blue line right here. And then the Dow Jones is this green line right here. Obviously, the Amazon's been beating the market. As you can see, it's up 16% on the year, and the Dow is down 4%. So that being said, you see how it can kind of follow the market. So we'll look here, for example. You have Amazon peaking out. The market's still trending up. And then the market starts trending down, and so does Amazon. So a lot of this is because Amazon's such a big player and a big tech company that it has a lot of influence on the market. So if Amazon misses earnings, that's a good forecast that some other big tech companies might miss earnings, whether that's due to tariffs, sales, or this, that, and the other. So they have big roles in the market, whereas some small cap companies, some mid cap companies, might not have such a big influence on the market. So that's just another thing to keep in mind. Whatever stock you're trading, you want to know how it works with the market, so hand in hand. And then the other thing is that when you're trading a stock, that's your money. So you want to know where your money's going. You want to know what the company plans on doing. You want to know when their earnings come out, because you don't want to hold right before earnings and then you hold through earnings and they miss earnings, and then they miss earnings and then the stock plummets and you're stuck holding it over pre-market hours or after market hours, excuse me, and then there's nothing you can do about it till market open, and then you sell it and you're down whatever percent. So that's another thing you want to keep in mind when their earnings are, how the company's performing in comparison to their competitors. So Kronos Group's competitors would be like CGC, which is like another marijuana stock. So a lot of these marijuana stocks, they normally trend pretty similar just because they're in the same industry and they're all fairly new. It's a pretty new industry. So that's another thing you want to keep in mind. So comparison to the competitors, when their earnings are, you really don't want to hold through earnings unless if you're super confident and you're willing to risk that whatever percent gain or loss that you could potentially lose. And then the last thing I wanted to go over was always stick to your plan. So there's been multiple occasions where I've analyzed stocks. I had a good idea what direction it was going to go, but I just, people, it's all in your head. It's psychological. Like I would look at the amount that I could be down. I could be down like 2%, and it could be a large dollar amount depending on your account. So I would sell, and then the next thing I know, it does exactly as I planned, bounces off of support and continues trending up. And then I lost that $200, even though I could have made X amount of money for, that's just an example. But always stick to your plan. Know where the market's going. Have a good idea, a broad idea on the whole market as a whole. Know your stock, what you're investing in. Use ratios, whether it's the 5 to 1%, 5% potential for gain to a 1% potential for loss is like a pretty common ratio in trading stocks. I think it's a good ratio. It works for me. It works for Cole. Works with a lot of other people that I've talked to. So that's pretty much it for today. I'm trying to see if there's anything else that I forgot, but that's pretty much going to do it for today's video. So a lot of these things I just put in my notes. That way, whenever I analyze a stock, I can look at my checklist, and if it meets all these the criteria for my risk and it offers that percent that I want, then I'll put it on my watch list, which is over here. We'll be making videos on how to add a watch list and all that. This is just a quick video going over risk management and some of the practices that we do. So if you guys enjoyed the video, feel free to drop a thumbs up, subscribe, and then all the links to the social media will be down below, as well as the Discord chat, and we'll see you guys in the next video.